The Federal Reserve has a new plan to crash the market in the back half of 2023. We're going to get into all of that in this video. It's getting juicy out there. It's getting spicy out there. But first, I'm Austin. I'm a co-owner of TopBusinessSuite.com, and I'm a stock market investor, of course. Thank you for being here. If you're one of those 260-ish subscribers we got, thank you so much. If you're not one of those people, go ahead and become one of those people by clicking that subscribe button. Help us on the way to our 500 subscriber goal in the near term. As a thank you for doing that, here's a picture of both my cats. Here's Millie and Luna. Millie's the gray one, Luna's the brown one. They thank you for subscribing. All right, let's get into this. So the Fed just recently caused a market pullback already just by saying, hey guys, we're not gonna raise rates in the month of June 2023, but we might go ahead and raise in July 2023, and we could see as many as 2 more quarter point rate hikes. So for context, we're sitting at 5 to 5.25%. And the Fed came out and said, hey guys, although we're not raising this month, we might raise in July. That caused a little bit of a pullback on the first day they said that. The next day we were green in a pretty decent way. All the indices are up at least 1%. And then the next day we crashed down pretty substantially, with small caps and mid caps getting hit the most, because those are the companies that get hurt the most whenever interest rates go up, because debt gets more expensive, okay? So the Fed is trying to forecast that, hey, we might raise in the back half of 2023. I personally think they're bluffing, or the chances of them raising are extremely, extremely low. But I think what they're trying to do is to kind of cool the market just a little bit, cool the stock market, so that we don't go on a parabolic run. If they came out and said, hey, we're done raising rates for all of 2023, we're going to either keep it at 5 to 5.25, or we might even cut in the back half of the year. Although I think that's the most probable scenario, if they came out and said that, the market would roar higher, especially small caps and mid caps. Holy cow, we would see risk on. Money would flood into all the stocks that have gotten thrown in the trash over the last 18 to 24 months as inflation has gone up, and we've had to fight inflation by pulling interest rates up. The Fed had to increase rates. Although they did way too much, way too late. They always do this thing. They always stay way too late to the party. So whenever interest rates were at 0 and inflation was soaring to the moon, they said, hey, inflation is transitory. Everyone, literally everyone was like, inflation is not transitory. They stuck to their story. They finally realized that inflation is not transitory, meaning it's here to stay, and they had to fight it. So now they had to come in way too late and raise rates way too high, up to 5, maybe even 5.5 or 5.75, which is very, very, very high. But what I think they're doing is they're trying to cool the market off so that if something does happen and we see a re-acceleration of inflation, although inflation's been coming down substantially over the last 6 to 8 months, if we see an uptick in inflation and they feel like they have to raise again, rather than them saying, hey, we're done raising, and then they have to flip and say, oh, just kidding, now we have to raise, that would make the market tank. I would say probably 15 to 20%. By them saying, hey, we're not sure if we're gonna raise, it's on the table, but we're really not sure yet, we have to wait and see, make a data-based decision. Then when they do raise, if they had to in July or later in 2023, I think it would cause like a 5 to 10% pullback, which would still be a lot of pain out there, because if the index is dropped by 5 or 10%, some small caps are going to drop by 20, 30, 40%. Some mid caps are going to fall by 15, 25, etc. So it would still cause a lot of pain, but it wouldn't be nearly as bad as like a 15 to 20% pullback in the indexes, in which we could see small caps get destroyed and mid caps get destroyed. That's just how it works. The big dogs fall a little bit, the small guys get wrecked, especially in a high rate environment, because companies that are way smaller typically aren't at massive stages of profitability yet, which means they have to take on more debt than a huge company, right? So they feel the pressure of higher rates, and on the other side of that, they feel the pressure of high inflation more than a huge company as well. So they kind of get double screwed in a high interest rate environment, especially when they're trying to raise because inflation's high. Now they're getting double whammy wrecked, while the big caps or super mega caps, like the big tech companies, they get hit a little bit, but not in a substantial way like the smalls and mids do. So moving forward to the back half of 2023, I do not think the Fed is going to raise anymore. I think they're going to keep it at the 5 to 5.25, and I think there's possibly a quarter point rate cut coming. And if there's a rate cut happening, the market is gonna soar to the moon. So what I would do in this situation is I would not wait with cash on the sideline any longer. That said, I also wouldn't deploy all my cash at once. Never a good idea to deploy all cash at once, but slowly be a buyer. If you've been staying on the sideline, I would say start buying now, because you don't want to miss the ripper rally that might happen in the event that the Fed ends up cutting, or they say, hey, we're done raising raising for all of 2023. Both of those things would be huge risk on signals for the market, and the market would absolutely roar higher. So this reminds me of that old quote, time in the market beats timing the market. If you're trying to time the market around Fed decisions, I think it's a bad idea. Better to just stay invested, and if the stocks that you like move lower, or even the indexes move lower, if you're an index fund investor, just go ahead and buy more of those underlying assets at a slightly discounted price. Okay, that's the best situation. Maybe you're taking a loss on that right now. It's a paper loss. You can bring your cost basis down. Maybe you have a little bit of a gain, but you still wanted to build out that position. You can build out that position. Maybe you see some great opportunities like Disney stock and PayPal stock, etc., that are very undervalued right now, or Whirlpool, some other companies I think are undervalued. You can go ahead and buy up shares at the low prices and then get a nice price appreciation as the stock market moves upward. And some of those companies are dividend payers, so you're going to get a nice yield on cost moving up as they increase that dividend over the coming years. So best case scenario for you right now is to be a buyer, okay? Whenever we see weakness in the market, it's the best time to be a buyer. If we see more weakness and the Fed decides to raise another quarter point, which I think would be very unlikely and very unwise, I still think you should be a buyer. You should be buying free cash flow positive companies. You should be buying EPS positive companies, because we don't want to be in companies that are going to be serial cash raisers, whether that be through debt, because we know interest rates are going to be going up. And even if they're not going up 5% to 5.25%, that's extremely, extremely high for the Fed funds rate. So debt is very expensive right now. We want to be with an EPS positive company so they can fund their own operations without the use of debt. And then there's some companies who like to be share diluters, okay? So they're gonna increase the total number of shares outstanding to raise cash, which screws you over as the investor, because the share price is gonna come down because the total number of shares outstanding is gonna increase. Even if the market cap stays the same or moves higher, it's gonna screw you over as the investor on your total return. So we don't want debt-ridden companies, we want EPS positive companies, we want free cash flow positive companies. So make sure you're looking at statement of cash flows, make sure you're looking at the balance sheet, and make sure you're looking at the income statement on all stocks that you ever consider buying. So let me know if you think the Fed is going to try to raise rates and crash the market, or if you think they're bluffing. I definitely think they're bluffing, but I want to hear your thoughts. Let me know in the comments. Let's get some debate going on down there. If you've been here this long and you made it to this point in the video, go ahead and like the video for me. You clearly liked it, so thank you so much for being here. Hit that subscribe button, and I'll see you next time.